talk a little bit more about that and the broader markets as well with Ryan Detrick, Carson Group Chief Market Strategist. Nice to see you, sir. It has been, as I mentioned, a brutal week for housing data. What does it tell you about what is to come in the new year?
Yeah, it absolutely has. First off, thanks for having me back. It's nothing new. Like you said, down 10 months in a row, huge drop. What's unique to us, though, is you look at some housing stocks. They've actually had some impressive things to say, and they've been holding in there. So it's kind of a yin and a yang. I mean, I'll tell you what, the economy, we get in all this stuff. The economy to us is likely not going into recession next year because the consumer is so strong. Yes, housing is likely in a recession. Manufacturing's teetering with the recession. So it's a slowdown for sure, but I think it's as simple as, listen, rates have doubled in the past year, or at least 30-year mortgages have. And that's one of the big reasons why that's happening. The Fed wanted this to happen. The Fed wanted things to slow down. So the Fed's kind of getting its wish, I guess you could say also.
Ryan, what about over the next 2 weeks? Because lots of focus here on whether or not we are going to see a Santa Claus rally. We've seen one every year in the last 6 years. We're looking at 2 days of gains. We don't want to get too excited at this point. But is the Santa Claus rally, is that still in the cards?
We think it is. I mean, I think it's one of the more misunderstood things because technically, guys, the Santa Claus rally is the last 5 days of the year, then the first 2 days of the following year. Like you said, up 6 times in a row. All right, it hadn't been up 7 times in a row since like the 60s. But when you get this oversold market like we've had, negative sentiment, now some decent news right out of Nike, and I don't know if FedEx is really even that good what they had to say, but the stock's reacting positively. So there are some things, like that consumer confidence. Let's talk about that consumer confidence for a second. I mean, that's a really big jump. Again, one of the big reasons that we're kind of awfully lonely with our call of likely not a recession next year is because that consumer is so strong and that confidence number is a good thing. But to answer your original question, yeah, we think Santa Claus can come to town. These 7 days, guys, are higher about 80% of the time historically. With an oversold market, we think Santa Claus could come to town once again over the next week and a half or so.
When Santa does not come to town, what generally follows and what's the precedent there?
Yeah, that's what a great question, because that's when things aren't so great. We look at the last 5 times Santa Claus did not come to town. January was lower every single time. And some of those years were 2000 and 2008 that we didn't see a strength during the normally seasonal period of strength during the Santa Claus rally. So bottom line, starting Friday, stocks should go higher. If they don't, that potentially could be a warning sign that something's off, something's wrong. Believe me, we've done a lot of things wrong with this year so far. But we do think that October low is the low of the bear market. 6 of the last 17 bear markets ended in October. We know we've given some back, but at the same time, we think that's the lows. And if Santa Claus comes to town, then things should be perfectly kind of more normal, which is a good thing, I think.
Ryan, let's take the scenario where Santa Claus does come to town, because a little bit more optimistic than when we look out into the new year. What are you advising investors out there just in terms of where they should be allocating their money? Is it going to be another year where once again we see value outperform?
Mm-hmm. Yeah, we do like value still. I've come on the guys all year saying, we're not so warm and fuzzy on technology communications. We've been overweight value. I mean, you showed some of the best performers today. You've got energy and industrials. I mean, those have been leading. We're really impressed with industrials, right? That dollar weakness that we're starting to see, something a lot of people aren't talking about, as you head into next year. The dollar weakness can really be a tailwind for global earnings. We all know this, right? 40% of revenues come from overseas for the S&P 500. A weaker dollar, like we're anticipating, could be a little bit of a tailwind for earnings actually coming better than people think. Nobody's out there saying that. The other thing on this, everybody's saying the first half of the year next year is going to be just really rough. And we get it. We see the same things other people see. Something I don't know people are talking about. 17 of the last 18 times, guys, in a pre-election year. All right, it's back to 1950. That first quarter, so that's next quarter, was higher. That's 17 out of 18, all right? That's the best quarter in a 4-year presidential cycle. The second quarter is pretty good, too. I think I'm open to the idea that we could have a surprise rally the first half of next year with inflation coming back, the economy not going into a recession, and everybody is bearish. Markets have a funny way of kind of surprising the masses when that happens.
China reopening could help in that capacity. You briefly mentioned tech. What about your thoughts on healthcare moving forward?
Yeah, we like healthcare as well. I mean, healthcare's kind of got some defensive and some offensive attributes to it. Bottom line, some solid earnings. Just some upward momentum, right? There's some relative strength taking place there. Drug companies, boring old drug companies have done really well also. So healthcare definitely is one of our favorite groups, along with kind of those cyclical value areas. We also like small caps. Haven't done as well lately, I'm aware, but those are some of the areas that when we invest for our Carson partners, our advisors, those are areas we're saying you should look to in 2023 for opportunity.
Ryan, the Fed obviously a key driver in all of this. I guess, what do you think it's going to take in order for the Fed to maybe back off some of their hawkish rhetoric that we have come to expect here since the last couple of meetings?
Yeah, I mean, I think it is as simple as inflation keeps coming back, right? I mean, we're seeing that. Now, I'm aware we had a good inflation data last Tuesday. The Fed came out Wednesday and upset the apple cart. But, another month or two of good inflation data, that could be what it takes for the Fed to take their foot off the pedal. I mean, we've all talked about this, right? Rents make up 40% of CPI. Rents are coming down significantly. If you look at some of the, the private data out there, like Apartment List and Zillow, that's not in the government's data yet. It will be, next 6 to 12 months. So used cars coming back, rents coming back, medical insurance coming back. Some of these things were the reason inflation stayed so stubbornly high, and it is still stubbornly high, don't get me wrong. But now these should be tailwinds. If that could come back like we think it can over the next, we'll say 3 to 4 months, that could be the thing that the Fed could finally say, okay, do that with their hands. Our job is done. Inflation's come back. And that'd be something a lot of people don't expect, but we think it could happen. It could be a good thing.
So, Ryan, I guess more specifically then, how big of a drop do we need to see with inflation? Because it has come back just a bit, but still at 7.1%. So like you were just saying, very high historically speaking, although it has been a bit of improvement since it did peak. Are you talking about another percentage point drop? Do we need a drop to 5%? I guess, what do you think the Fed will be satisfied with?
Yeah, over the next 3 to 4 months, it potentially could drop to the low fives, right? If we just keep getting 0.1% month over month, if you kind of extrapolate that out. So it could happen a little quicker than people think. If the Fed's going to have another one or two rate hikes, CPI and the Fed's fund rate will be both right around 5% potentially by the time we get to April or so. And that could be kind of that area where they could say to take their foot off the pedal to the metal. Just one more quick comment on this. 15 months ago, the Fed was looking for one rate hike of 25 basis points. Now they're super hawkish. I'm not a Fed hater or a Fed basher. I'm just saying they don't have always the best track record with this. And again, we're optimistic they're going to be a lot more dovish in the next year than they think they are right now.
All right, good stuff there, Ryan Detrick. Good to see you, my man. Merry Christmas.